Hey everyone, tonight we're going to dig deeper into a problem that's been brewing for years, one that rarely shows up in headlines until it's already reshaping the economy from underneath. As I sit here in my office with the screens flickering their muted blues and greens, I'm witnessing something unusual happening in the United States, something quiet, persistent, and far more consequential than any single data point or political soundbite. Internal political polarization is beginning to shape the economic landscape in ways that most people don't see yet. And as I track these shifts in real time, I can feel the early vibrations of a cycle I've watched unfold in other nations and in other eras. If you're listening from your living room, maybe after a long day, or if you're commuting through a noisy city with earbuds in, I want you to know this. You probably won't make it through this cycle if you don't understand how political fragmentation affects economic resilience. It doesn't come at you loudly. It arrives slowly in behavioral changes, hesitant decisions, eroding trust, and subtle distortions in policy. But those quiet shifts accumulate, and eventually they become the economic environment itself. So before you get comfortable, take a moment to watch the video and subscribe, but only if you really like what I'm doing here. As I focus on the screens, I'm noticing the early rifts more clearly. They show up in the way businesses delay long-term investments because they aren't certain what regulatory regime will exist 5 years from now. They show up in how households adjust spending patterns because they don't trust fiscal policy to remain steady. They show up in the instability of bipartisan negotiations over debt ceilings, budgets, and basic governance. None of this is dramatic, not in the way war or recession is dramatic, but it's foundational, it's tectonic. And tectonic pressures are always the most dangerous because they reshape the ground before anyone feels the earthquake. One mainstream macroeconomic fact is playing out right now. Economies depend on trust just as much as they depend on money. Trust in institutions, trust in policy continuity, trust in the rule of law, trust in the functioning of government. When that trust erodes, even slightly, the economic system begins to strain. Borrowing becomes more expensive. Planning becomes more difficult. Capital becomes more cautious. And innovation becomes slower. There's a strange, almost irrelevant piece of economic history I can't help thinking about while I examine these patterns. In ancient Mesopotamia, city-states would sometimes appoint dual chancellors to oversee finances, two leaders from opposing factions working side by side. The idea was that shared power would limit corruption and stabilize the economy. But more often than not, it created gridlock. Decisions slowed. Financial commitments paused, trade weakened. It's an old problem with a modern echo. Too much division at the top weakens the base. As I analyze the latest confidence indices and survey data, I see the modern equivalent forming. Households feel that political leaders no longer represent common goals. Corporations feel that long-term regulations swing too widely between administrations. Investors feel that policy direction is reactive rather than strategic. And remember earlier when we talked about how tightening credit reveals cracks? This is similar political division reveals cracks in institutional reliability. The atmosphere in America is shifting. Not explosively, not dramatically, but unmistakably. You see it in the rhetoric around fiscal priorities. You see it in the difficulty of passing budgets. You see it in debates over infrastructure, healthcare, energy, and national security, all essential components of economic stability. When political actors can't agree on fundamentals, the economy absorbs the uncertainty. And it's not just Washington. State governments are drifting apart in their approaches to taxation, labor laws, technology regulation, and climate policy. This divergence can be healthy in small doses, but when polarization becomes the norm, businesses face a fragmented regulatory landscape instead of a coherent national strategy. It's the kind of fragmentation that slows growth, weakens competitiveness, and pushes investments towards safer, less productive uses. As the hours pass tonight, I can feel the same quiet tension I sensed during past cycles. Late 1,970 seconds, stagflation. The early 1,990 seconds, fiscal battles. The post-2008 political realignment. Each period began with small fractures in political unity and ended with those fractures shaping economic outcomes. People still debate whether those transitions were necessary or avoidable, whether leadership failed, or whether the pressures were simply too great. But cycles have a way of repeating because human nature repeats. I watch the screens again. Treasury yields shift slightly. Market volatility sits just below the surface. Consumer sentiment dips a little more. It's not enough for most people to notice, but it's enough for the economy to feel it. You might wonder how polarization directly affects resilience. The answer is that economic resilience relies on adaptability. And adaptability requires alignment between policymakers and markets, between states and the federal government, between competing interests that nonetheless share a common foundation. When that alignment breaks down, resilience thins. The economy becomes more sensitive to shocks. Small disruptions feel bigger. Small disagreements become crises. Small policy delays become costly. Tonight, I'm watching the early rifts develop, not dramatically, but steadily. And steady erosion is always more dangerous than sudden shocks, because you don't realize how much foundation has disappeared until you finally need it. Now, let's get to tonight's analysis. I'm watching trust erode gradually now, not through explosions or headlines, but through a steady thinning that moves across the economy the way evening fog creeps along a coastline, quiet, slow, but undeniable. As I sit here in the calm of this room, the monitors glowing faintly against the dark, I can sense the shift in a way data alone can't fully capture. There's a tone in the markets, a hesitation in the decisions of households and firms, a subtle tightening in state budget signals that tell me institutional confidence is weakening in real time. Trust in an economy behaves like oxygen. You don't notice it when it's there. You only notice it when it begins to disappear. And right now, I'm seeing that disappearance in the small but meaningful gaps between expectations and behavior. Investors expect stability, yet they hedge more aggressively.
Businesses expect consistent regulation, yet they delay long-term commitments. Households expect reliable governance, yet they're saving more defensively and consuming more anxiously.
These are quiet adjustments, but they're adjustments rooted in growing uncertainty about the system itself. A mainstream macroeconomic fact comes to mind. Economies don't grow on capital alone. They grow on confidence. Without confidence, capital hides. It protects itself. It moves cautiously. And when capital becomes cautious at scale, the entire system begins to slow. That slowing isn't visible at first. It appears in softer job postings, smaller investment rounds, delayed hiring, trimmed spending plans. And tonight, I'm watching those signals multiply. As I scroll through regional credit surveys, the data shows that small businesses, often the best real-time indicator of economic sentiment, are becoming more reluctant to borrow. Not because opportunities have vanished, but because they can't predict the policy environment surrounding labor rules, taxes, or trade. When political polarization clouds the landscape, entrepreneurs become their own risk managers, and risk managers don't take unnecessary chances. They wait. And waiting, multiplied across millions, becomes an economic condition of its own. There's an odd piece of economic history I can't help recalling. During certain dynasties in ancient Korea, farmers would bury their grain harvests in hidden pits during periods of political tension, keeping reserves outside the taxation system, not because they wanted to rebel, but because they wanted certainty. They wanted control over their own security. Today, the modern equivalent is households increasing precautionary savings and businesses holding more cash on their balance sheets. Different era, same instinct, uncertainty drives protection. Tonight, I shift my attention to the federal and state confidence metrics, those surveys that often go unnoticed but reveal so much about where the economy is heading. Confidence in Congress is near historic lows.
Confidence in long-term fiscal management is fragile. Confidence in regulatory predictability is thinning. And it's not just political opinions, it's the behaviors that follow them. States are adjusting budgets more conservatively. Municipalities are reframing bond offerings. Federal agencies are hesitating to commit to long-range projects without political alignment.
Remember earlier when we saw those subtle shifts in corporate refinancing behavior and household credit patterns? Now those financial constraints are merging with political uncertainty.
The combination is a kind of double tightening, first economic, then institutional. And double tightenings have a way of weakening resilience far faster than either force alone.
As I watch the bond market react, yields rising a little tonight, spreads widening just enough to suggest caution. I feel the erosion of trust manifesting in market language.
Investors price uncertainty long before the public sees it. They demand a little more yield here, trim exposure there, test liquidity in corners they previously ignored. It's like watching animals sense an approaching storm long before the sky darkens. People still debate whether political polarization truly affects economic outcomes or whether markets ultimately ignore the noise. But that debate misses the point. Markets don't ignore noise, they compensate for it. They price it in, they shift behavior around it, and when uncertainty grows large enough, it becomes part of the economic baseline. I look out my window for a moment. The city lights steady but thinner than usual, as if the whole place is holding its breath. Maybe it's just the hour. Or maybe it's the psychological weight of a society that feels divided while navigating a late-stage economic cycle.
That combination, late cycle fragility and political distrust, is historically one of the most challenging environments for resilience.
Inside households, the erosion appears in conversations about jobs, in concerns about retirement savings, in the quiet recalculations families make about future plans. Inside corporations, it appears in slimmer forecasts, adjusted projections, and more cautious capital expenditure. Inside government, it appears in sharper rhetoric and slower compromise. And inside markets, it appears in that subtle shift I'm seeing right now, liquidity becoming a little more precious. Trust is the lubricant of an economy. And when that trust erodes, even modestly, the engine begins to grind. As the hour grows later, I'm still observing these signals unfold, not dramatically, but steadily. And steady erosion is far more dangerous than sudden shocks. It shapes sentiment, it shapes decisions, it shapes the future. I'm watching fractures shape policy tonight, the way thin lines spread across glass before anyone hears the break. It's subtle, almost invisible if you're not paying attention. But from where I'm sitting, screens glowing softly in the dim room, charts updating with their slow, rhythmic pulses, it's clear that political polarization is no longer just a background condition. It's shaping the very policies that would normally strengthen economic resilience during late cycle stress. And instead of alignment, what I'm seeing is distortion. When a system is polarized, policy making doesn't follow strategy, it follows incentives. And incentives in a polarized environment rarely point toward long-term stability. Right now, I'm watching fiscal debates twist around party identity rather than economic logic. I'm seeing monetary policy forced to operate in an environment where fiscal unpredictability adds unnecessary noise, and I'm seeing state-level policies diverge so sharply that the national economic landscape resembles a mosaic rather than a unified market. A mainstream macroeconomic fact becomes crucial at this stage. Resilience depends on coordinated responses. Whether it's inflation, debt rollover, productivity stagnation, demographic pressure, or geopolitical uncertainty. The system needs policy coherence, but polarization breaks that coherence. It turns straightforward decisions into battlegrounds, delays into stalemates, and simple adjustments into multi-month negotiations. The economy doesn't pause while policymakers argue, it reacts. As I examine the latest fiscal projections, I can see the effects of these fractures. Budget proposals swing dramatically depending on which political faction holds temporary leverage. Infrastructure plans stop and start. Tax frameworks shift with transitions in power. Regulatory priorities reverse direction every few years. These oscillations aren't just politically inefficient, they create economic instability. And there's a strange historical insight echoing through my mind. In medieval Venice, major political councils were intentionally designed with overlapping jurisdictions, so no single faction could dominate. It was meant to preserve balance. Instead, it created an environment where decisions took years, sometimes decades, trade slowed, investment drifted to more coherent city-states. The metaphor isn't perfect, but the lesson is fragmented governance weakens economic momentum.
As the hour deepens, I turn my attention to the bond market again. You can see political fractures reflected in how Treasury yields respond to budget uncertainty.
Every time there's a stalemate over debt ceilings or spending bills, yields shift, not massively, but noticeably enough to signal distrust. Investors don't like unpredictability, and political unpredictability becomes economic cost. People still debate whether political polarization actually impairs fiscal credibility or whether markets simply adjust. But the more I study cycles, the more I see how political fragmentation reduces the effectiveness of policy tools. Monetary policy becomes overburdened when fiscal policy can't coordinate. Fiscal policy becomes crisis-driven when political actors can't plan beyond the next election cycle. And long-term investments, education, infrastructure, innovation become the casualties of short-term agendas. Businesses feel this. I'm seeing companies revise long-term strategies around the assumption that policy might swing sharply again in a few years. They diversify operations not just globally, but across U.S. states. They reallocate capital toward flexibility rather than ambition. And when ambition shrinks, growth follows. Households feel it too, though differently. Tax uncertainty creates anxiety about future disposable income. Shifting healthcare and education policies make planning difficult. Polarized rhetoric increases psychological stress, which influences financial behavior in subtle ways: lower spending, higher precautionary savings, more risk aversion. Tonight, the data on my screen illustrates these fractures in unexpected places. Loan officers citing regulatory uncertainty as a reason for tightening.
State treasurers warning of policy misalignment affecting bond issuance. Corporate CFOs mentioning unpredictable legislative environments in earnings calls.
It's all part of the same cycle. Fragmentation shapes policy, and policy shapes resilience.
And remember that yield curve we talked about earlier, the one that kinked slightly before tightening deepened? Now, that kink interacts with unpredictable policy signals.
The combination is more than additive, it's multiplicative. When markets can't predict policy, they protect themselves. And widespread protectionism, whether political, financial, or behavioral, slows an economy.
There's another odd anecdote from antiquity. In certain Chinese dynasties, officials used mirror offices, two parallel teams assigned to the same task, but loyal to different factions. It was meant to ensure oversight. Instead, it created paralysis. When everyone guards the future, no one builds it. I look again at the screens: bond spreads widening, consumer sentiment dipping, investment flows stalling. No crisis, no collapse, just hesitation. And hesitation
scaled up across millions, becomes drag. Drag on growth, drag on innovation, drag on resilience. As political fractures deepen, economic choices narrow, and narrowing choices are the clearest sign that a cycle is tightening. I'm watching economic motion slow now, not because of a single shock or dramatic collapse, but because polarization is constraining the system's ability to move with confidence. It's late again, the kind of quiet hour where the hum of the monitors feels louder than normal, and as I study the flow of data, I can feel the drag settling in like a weight across the economy. Motion slows first in places people don't look. Planning cycles, long-term investments, research budgets, infrastructure timelines. And when political disagreement thickens the air, that slowing becomes more pronounced. Right now, businesses aren't freezing, they're hesitating. Households aren't collapsing, they're tightening. Governments aren't failing, they're stalling. And stalling, when magnified across millions of decisions, becomes one of the most powerful forces in any economic cycle. A mainstream macroeconomic fact stands out sharply tonight. Economies expand when confidence aligns and contract when uncertainty fragments action. Even without recessionary indicators, even without financial panic, an economy can lose momentum simply because its participants stop acting decisively. And political polarization injects that hesitation directly into the bloodstream of the system. As I scroll through charts showing declining capital expenditures and flattening business formation rates, I'm reminded of the uncertainty tax, a cost not written in statute but extracted from every indecisive moment. You see it when a CEO delays a factory expansion because they're unsure if future tax rules will reward or punish investment. You see it when a startup postpones hiring because labor regulations shift unpredictably. You see it when local governments hesitate to commit to long-term infrastructure because federal partnerships might change overnight. It's not paralysis yet, but it's slow-motion decay. And there's a strange historical detail I can't help thinking about. In medieval Persia, traders would hang small copper bells on their wagons. When political conditions were stable, the bells rang loudly in bustling caravans. During political upheaval, the bells grew faint. Fewer goods, fewer merchants, fewer risks taken. Today, our bells take the form of freight indices, logistics flows, and capital expenditures. And lately, they've been ringing much more quietly. I glance at my screen again, the freight index down slightly, real estate investment drifting sideways, small business optimism soft but not collapsing. The data doesn't scream crisis, but it whispers inconsistency, and inconsistency slows everything. Markets feel the slowdown too. Equities drift in narrow ranges. Trading volumes thin. Volatility rises, but in short bursts rather than sustained waves. It feels like a system waiting for direction, not frozen, but unwilling to commit. And that unwillingness is the defining characteristic of economic motion constrained by political conflict. People still debate whether political polarization is the cause or the symptom of economic slowdown, whether the uncertainty precedes the stagnation or simply amplifies it. The truth is probably both. Cycles interlock. Political gridlock weakens resilience. Weakened resilience intensifies political gridlock. Once the feedback loop forms, it reinforces itself with surprising force. As I consider the corporate sector, I can see adjustments happening everywhere. Multinationals diversifying supply chains across more regions, not because it's efficient, but because it's safer. Financial institutions increasing liquidity buffers, not because they expect collapse, but because uncertainty demands caution. Technology firms delaying large-scale investments, not because innovation has slowed, but because regulatory clarity has. Households are reacting in their own quiet ways, too. They're substituting cheaper products, reducing discretionary travel, building rainy day funds, Debt repayment patterns shift subtly, slower for credit cards, slightly faster for mortgages, inconsistent for personal loans. These behavioral adjustments might not sound dramatic, but when millions of families begin to conserve instead of consume, the economy decelerates in real time. I take a slow breath and listen to the soft hum of the room. These late-night hours tend to reveal patterns more clearly, perhaps because there's nothing else to distract from them. And what I'm seeing now is a pattern I've watched before in Japan during its lost decade, in parts of Europe after the sovereign debt crisis, in emerging markets caught between political rivalry and economic fragility. The specifics differ, but the dynamic is the same. When political conflict reduces the system's room to maneuver, growth weakens, innovation slows, and productivity falters. And remember that earlier sentiment shift, the trust erosion, the credit tightening, the hesitant markets? This section is where all those elements come together to affect the real economy. Actions slow, reactions slow, adjustments slow. The entire system develops a kind of inertia. There's another odd economic practice from ancient times that surfaces in my mind. In parts of early Rome, merchants would temporarily close shops during uncertain political transitions, not out of protest, but because uncertainty reduced trade to a trickle. They reopened when predictability returned. We don't close markets today, but we do reduce motion. And reduced motion in a complex system is its own form of stress. As the data continues to flicker on my screen, I can feel the energy of the economy shifting, not collapsing, just cooling. And cooling during a late-stage cycle is often the signal that the spiral is tightening. Economic motion slows quietly, almost imperceptibly. But once it slows enough, the next stage of the cycle begins. I'm sensing the deeper strains now, the kind that don't just sit on the surface of the economy, but seep into its foundation. These are the pressures that accumulate quietly over years and then suddenly matter all at once when the cycle tightens. Political polarization doesn't just shape policies or slow economic motion, it amplifies vulnerabilities already embedded in the system. And as I sit here tonight, with the screens flickering softly and the late-night quiet settling over the city, the weight of those interacting weaknesses feels heavier than before. The first layer of strain comes from demographics. A mainstream macroeconomic fact is that economic resilience requires both productive workers and stable population growth. But right now, the U.S. is aging. Birth rates are low, retirements are accelerating, immigration flows are unpredictable, and the dependency ratio is rising. Without political alignment, demographic challenges become harder to address, harder to mitigate, harder to plan for. And polarization has turned every demographic policy, immigration reform, family benefits, retirement, changes into battlegrounds rather than solutions. When demographic decline meets polarization, long-term investment thins. Governments hesitate to fund education reforms. Businesses hesitate to commit to workforce development. Communities hesitate to plan large-scale infrastructure. Everyone waits for clarity that never comes. There's a fringe economic insight from ancient Egypt that never leaves my mind. During certain dynasties, grain storage strategies were based on forecasting the political season rather than the agricultural one. Farmers saved more grain when they expected political discord, less when they trusted leadership. The result? Food shortages during prolonged instability. Today, we don't store grain the same way, but we do store capital, and capital behaves very similarly. It accumulates defensively when political fragmentation rises. The second layer of strain arises from productivity. Productivity growth in the U.S. has slowed meaningfully over the last decade. People still debate whether this slowdown reflects the natural limits of the digital economy or whether deeper structural issues, education gaps, infrastructure deficits, weak investment are to blame. Regardless of the cause, polarization amplifies the problem. Instead of unified strategies to boost productivity, we get competing agendas that partially cancel each other out, energy policy whiplashes between administrations, technology regulations swing dramatically, industrial plans take shape but lack durability. When productivity stagnates, the economy becomes more fragile, less able to absorb shocks, less able to sustain rising debt, less able to fund future obligations, and political polarization makes the path to reversing stagnation narrower and more uncertain. The third layer of strain comes from alliances, both domestic and international. Globally, geopolitical tension is rising, and U.S. alliances are being tested. Trade relationships are being rebalanced. Supply chains are being diversified. Foreign governments are reassessing their reliance on U.S. assets. None of this is catastrophic, but it's cumulative, and political conflict inside the U.S. makes external stability harder to maintain. At home, states are drifting further apart culturally, legally, and economically. Some are positioning themselves as innovation hubs, others as regulatory sanctuaries, others as fiscal strongholds. The internal divergence creates friction differences in taxes, education, labor rules, and governance models. In healthy cycles, diversity is strength. But in late cycle environments, divergence becomes drag. As I review the data tonight, aging population curves, productivity trend lines, cross-state investment patterns, I can see how polarization interacts with each structural weakness. It's not that these weaknesses are new. It's that the nation's capacity to address them is shrinking. Solutions that require compromise become nearly impossible. Long-term policies that require continuity become volatile, and uncertainty grows until it feeds on itself. Remember the earlier signs: eroding trust, distorted policy incentives, slowing economic motion? Now those forces are pressing on deeper structural vulnerabilities. When pressure meets fragility, resilience weakens. And weakened resilience makes the entire system more sensitive to shocks. There's another historical anecdote that fits too well. In parts of ancient India, regional kingdoms maintained separate taxation systems even under a unified empire. The result was fragmented governance and uneven economic development. When external pressures rose, the empire struggled because its internal divisions made coordinated responses nearly impossible. The parallel isn't perfect, but the dynamic is familiar. Fragmentation turns mild shocks into meaningful stress. As I shift my focus to the global stage, I can feel the tension between rising geopolitical competition and domestic political division. It's the kind of combination that challenges even strong economies. Supply chains become vulnerable. Defense budgets become politicized. Long-term commitments become provisional instead of strategic. People still debate whether polarization is a cause or a symptom of deeper structural issues. But in practice, it doesn't matter. It interacts with everything. It amplifies existing weaknesses, delays necessary adaptation, and makes shocks more destabilizing. As the quiet night deepens and the screens continue their subtle flicker, I can feel the system tightening again, not through crisis, but through accumulation. Layer by layer, the strains grow heavier. And in late cycle environments, weight alone can change the trajectory. I'm watching the markets sense uncertainty now, the way animals sense a shift in the air long before the storm arrives. It's subtle, but it's there in the numbers, in the behavior, in the tone of commentary from traders, analysts, and executives. As I sit here in the dim glow of the screens, charts flickering their late-night patterns across the room, I can feel the system reacting not just to economic pressures, but to political fractures that have become too persistent to ignore. The spiral is tightening, and markets more than any other part of the economy are revealing how fragile the alignment between policy and economic stability has become. Financial markets are forward-looking. They don't wait for data to confirm a trend. They price what they suspect is coming. And tonight, they're signaling caution. Treasury yields are behaving with a kind of nervous firmness.
rising when political negotiations falter, and dropping only slightly when temporary agreements ease the tension.
Equity markets are drifting with inconsistent conviction.
Credit spreads are widening just enough to indicate discomfort. Commodity prices are reacting to geopolitical cues more than supply fundamentals.
All of these signals point to the same conclusion. Uncertainty is increasing.
A mainstream macroeconomic fact confirms this pattern. When political fragmentation intersects with late-cycle financial tightening, volatility becomes more sensitive to news, confidence becomes more fragile,
and capital becomes more selective. And I'm seeing that play out across asset classes.
Investors are moving towards shorter maturities, safer credits, stronger balance sheets, and away from sectors exposed to regulatory unpredictability.
They aren't running, they're repositioning. And repositioning is often the earliest sign that resilience is thinning.
There's a strange historical insight that feels relevant here. In certain medieval Italian city-states, merchants would track political tension by monitoring the price of pepper, an imported good tied to trade routes and international stability. When political uncertainty rose, pepper prices spiked, not because demand changed, but because trust in trade continuity faltered. Today, pepper has been replaced by volatility indexes, risk spreads, currency options, and credit default swaps. But the principle is identical. Uncertainty reshapes markets even before fundamentals shift. I scroll through currency charts and see the dollar wobbling in response to domestic political events, a sensitivity that grows stronger when global trust in American governance becomes less stable. People still debate whether the dollar's status as the world's reserve currency is truly threatened or simply adjusting to a multipolar world.
But what's undeniable is that polarization makes it harder for the U.S. to project reliability. And reliability is the bedrock of global reserve currencies.
Back in the equity markets, I see a kind of cautious bifurcation forming. Defensive sectors, utilities, healthcare, staples are holding their ground. Cyclical sectors react more violently to political news.
Tech firms speak carefully about regulatory uncertainty.
Industrials delay forward guidance. Energy companies prepare for policy swings rather than stable planning.
It's a pattern I've observed before. In countries where political conflict began influencing capital allocation more than economic fundamentals.
Remember earlier when we talked about slowing economic motion and eroding trust? Now, those forces are shaping market psychology. Investors are pricing in more risk premia. Bond buyers are demanding higher yields for long-term commitments. Businesses are stockpiling cash. Households are reducing discretionary spending. Markets are telling a cohesive story. The system is becoming less predictable. As I study the bond market more closely, I notice the term premium rising not dramatically, but steadily. It's the market's way of saying we need compensation for uncertainty. In an environment where political actors struggle to agree on budgets, debt ceilings, or long-term fiscal frameworks, that compensation rises. And rising term premiums increase borrowing costs across the entire economy. It's fascinating and concerning to see how small political signals create outsized market reactions. A rumor about a legislative impasse can move futures. A hint of regulatory conflict can shift entire sectors. A heated press conference can widen spreads. When political noise has this much influence, it means the system has become hypersensitive. There's another peculiar economic practice from history that mirrors this moment. In ancient Phoenician markets, traders kept small bowls of water at their stalls. When the surface rippled without wind, they believed it signaled distant conflict or instability. Today, our water bowls, our liquidity flows, yield curves, volatility clusters, and credit default swap spreads. And tonight, the surface is rippling. People still debate whether markets overreact to politics, or whether politics underestimates its impact on markets. But the relationship goes both ways. Polarization shapes uncertainty. Uncertainty shapes markets.
And market reactions eventually shape the real economy. It's a feedback loop. one powerful enough to influence the trajectory of an entire cycle. As I sit back for a moment, listening to the faint hum of electronics and the soft tapping of data updates, I can feel how close we are to the edge of the next stage. Not collapse, cycles don't always end in collapse, but adjustment. Sometimes the adjustment is gradual, sometimes it's abrupt. But it always arrives when market psychology shifts from confidence to caution. Tonight, markets are speaking more clearly than policymakers. And what they're saying is simple. The combination of polarization and late cycle stress is weakening resilience. I'm watching the system reach tension now, the moment in the cycle where all the subtle forces we've traced finally converge. The room is as quiet as it has been all night, the screens humming softly, the data refreshing in an unhurried but insistent rhythm, and I can feel it almost physically, the weight of political polarization pressing against the weight of late cycle economic strain. It's not a crisis, not yet. But it's that unmistakable point where even small disruptions carry outsized consequences, where the system operates with less margin, less unity, and less resilience. This is the stage of the cycle where pressure stops being theoretical. It becomes visible, it becomes emotional, and in some ways it becomes inevitable. Right now, political polarization has seeped into nearly every channel that normally supports stability. Legislative gridlock makes fiscal planning uncertain. Fragmented regulatory priorities make long-term investment harder. Conflicting visions of economic policy create inconsistencies that ripple across industries. Agencies interpret laws differently. Courts face escalating ideological cases. States move in competing directions. And businesses, markets, and households react not just to the economy, but to the political weather surrounding it. A mainstream macroeconomic fact stands at the center of this moment. Economies under stress require coordinated action. When polarization prevents that coordination, resilience fades. A system without unity is a system with vulnerability baked into its structure. And tonight, I can see those vulnerabilities forming more clearly than ever. Corporate debt is rolling over at higher rates. Households are tightening budgets. Municipalities are juggling pension obligations and shrinking tax bases. The federal government is wrestling with higher interest costs and partisan disagreements over spending. Markets are pricing caution. Foreign investors are gauging political risk. And the public is watching all of it with a sense of fatigue that deepens as polarization hardens. People still debate whether polarization is the symptom or the cause of weaker economic resilience. But at this stage of the cycle, the distinction barely matters. The forces feed each other. Economic strain sharpens political conflict. Political conflict weakens economic adaptability. We've seen versions of this dynamic before in ancient republics, in shifting empires, in modern nations that reached late cycle inflection points. The pattern is always the same. Fragmentation raises the cost of cooperation just when cooperation is required most. There's a strange and rarely discussed piece of economic history that feels almost too relevant here. In certain ancient Southeast Asian kingdoms, leaders used double budgets, one public, one hidden, to navigate political factions during unstable times. It was inefficient, opaque, and ultimately unsustainable. The kingdom could survive for a while under dual structures, but when external shocks arrived, the system buckled because the underlying unity was already compromised. Today's equivalent is not double budgets, but double agendas, economic goals split by polarized political priorities. As I track the signals tonight, I see the system reacting with the caution that defines late cycle turning points. Liquidity preferences rise, lending standards tighten, investment horizons shorten, risk appetite fades, fiscal negotiations grow sharper, monetary decisions grow heavier. Wait and see becomes the quiet message embedded in millions of transactions. And in economic cycles, widespread hesitation is a form of tightening. This is the moment when resilience is tested not by crisis, but by pressure, not by catastrophe, but by constraint. And constraint becomes a teacher. It reveals where alignment has eroded. It exposes fractures long ignored. It forces uncomfortable questions about priorities, trade-offs, and national direction. Remember earlier when we saw the yield curve kink, the markets hesitate, the structural weaknesses magnify? Now all those elements are converging. Political fragmentation isn't just a background condition, it's the lens through which every policy, every market response, and every institutional decision is filtered. As I lean back for a moment, taking in the dim room and the quiet hum of the vents, I feel a familiar mix of caution and reflection. Cycles don't repeat perfectly, but they rhyme. And this stage, this convergence of political division and economic tension has echoed through history in ways too consistent to ignore. People still debate whether the system can adapt without a disruptive adjustment. Maybe it can. Americans have navigated divided eras before. Resilience has deep roots here. Innovation often emerges under pressure. But adaptation requires clarity. And clarity becomes harder to achieve when polarization clouds every decision. Tonight, the system hasn't broken. But it has reached a point where even steady hands feel the tremor of cumulative strain. This is the tension point. And what comes next, adjustment, compromise, or deeper division, will shape the next chapter of the cycle. I'm slowing down now, letting the screens dim and the noise of the cycle soften into something more distant. After walking through these layers of political polarization and economic tension, it feels right to settle into a gentler rhythm, as if the analysis itself needs room to breathe. The system hasn't collapsed, and that's important to remember. What we're witnessing is pressure, not an ending. Strain, not a breaking. And strain, when understood clearly, can be managed with a steadier hand. As I sit here, the quiet of the night feels a bit heavier, but in a thoughtful way rather than a fearful one. Political division has always been part of America's story, just as economic cycles have always been part of the world's story. The combination we're living through now is challenging, but not unprecedented. And because it's not unprecedented, we have patterns, historical echoes, past lessons to guide us. When societies recognize their fractures, they often rediscover their resilience. When economies acknowledge their vulnerabilities, they often find new sources of strength. Sometimes I think the greatest danger isn't the polarization itself, but the sense that people feel alone inside it. Yet no one is alone in a cycle. We all move through it together, households, businesses, policymakers, markets, and cycles, even in their hardest moments, bend toward adaptation. They remind us to recalibrate, to rethink, to rebuild. So as we close tonight's analysis, let the tension blur into something softer, let the details fade just enough for perspective to take their place. And let yourself rest with the reassurance that understanding the cycle is already a form of resilience. Thank you for being here, for thinking through these dynamics with me, and for supporting the work that goes into these late-night explorations. I appreciate you more than I say. Good night, and I'll see you in the next analysis.